Okay, welcome back. We had been computing the minimum variance frontier using with constraints. So we just keep going. We need starting values for W. So also notation W0. It's kind of indicative that that's a starting value vector. I choose here 0.3, 0.3, 0.4. If you want to play around a bit, I've been using other starting values for which your solution will look very weird. So therefore, here already you have a very simple example to show you that you need to watch out at least a little bit for the starting values you're using. Because in theory, we would think the starting value doesn't matter, although you know from optimization, most routines are local routines, so therefore you go down or uphill based on where you start, so the starting values matter. And here, in addition, I played around a bit to have the initial starting value not fulfill the first constraints. And that is a problem to optimizers usually. And here as well. But here I'm pretty safe. I kind of start with a roughly equal weight portfolio. That's a good starting value to work with. It adds up to 100%. Right, so I think that's the key here. And now I need to include the bounds. So I wanted to have no shorting and minimum diversification. That's the finance jargon. Mathematically, I basically want that the lowest holding in each asset is 0%, while the max is 50%. So what I do here, I create an I just call it object, maybe it's list or the like, I don't know, someone knows, how should I call it better? I think object is the wrong word, but I just keep using it then. So I create an object here which contains 3 times lower and upper bound, because we have three assets, so therefore we will have 3 holdings. So our W is 3-dimensional, and now for each dimension we are telling later the optimizer what's the lower and the upper bound. And in this example they're all the same, 0 and 0.5, but they could be different, as you see, among different assets. Good. What we're now going to do is again we are going to loop through a grid of target expected returns, like we've done in the unconstrained or in the unbounded optimization. So now I use 100 grids. I specify the min to be 001, the max 50%. We have increments like in the previous optimization problem, so I can save some time over here. Next, I generate again storage and assign values to 0 for the expected return vector on the frontier, as well as the volatility and the vector of portfolio holdings. The little c is just to highlight to me or to other readers if they were to compare it with WMV previously. This is for the constrained case, where we have these 2 bounds. Okay, now let's look at what we're doing here. We have a similar loop. What I'm doing now, slightly different, to show you there are different ways to come up with the same issue. I define a term, mu target, outside of the loop, and then I'm incrementing mu target inside the loop. Previously we did it slightly different, and now I'm saying outside of the loop, mu target is initialized to be mu min. I have a for loop in range, so we talked about how to read that, and now you see I can directly start and call the optimizer. So I'm here calling the optimization function minimize. If you go through the documentary of that function, you see through that method, you see it requires the objective function listed first, which I did. Then it wants starting values, and it wants the constraints. These are the same constraints we had before, these equality constraints. And now we also add bounds, which are the no shorting constraint and the minimum diversification constraint. So that's what I'm adding here. Why are these the same names? That's kind of coincidence. Yeah, Python, the function wants the term bounds equal, and then now I can give something that relates to the bounds. I just like to use exactly the same term. Okay, great. And otherwise, the minimization is done. It's stored in the object WI. And now if I go through the documentation of this scipy.minimize function, I will get to know that if I press WY, so the object .x, it's like getting the member out of this object. I'm getting a row vector out, and the row vector in the finance context will be my portfolio holding on the minimum variance frontier that fulfills the constraints and the bounds. And I'm saving that here. Okay. Otherwise, I compute the expected return and the vol, like we've done previously. And then you see I'm now incrementing the mu target by mu increment, which is also computed here outside of the loop. Okay. Now, whenever I said Python works with indentation, so we don't have brackets, but it's clear then when I start on the same line, then 4, this is outside of the loop. And here I just want to remind you, if you write bigger code, you should free up storage. So if mu target will not be needed anymore, so it's just also safe to delete that, frees up storage. Yeah? And for this Mickey Mouse example, it of course doesn't matter, but if you work with big data applications, it matters. Okay. And if I now plot, we see exactly the initial picture I started off with. We see that the efficient frontier, although we wanted 100 points, here we characterize, it looks like less than 12 points. For the other points, for the other target expected returns, we cannot find the portfolio. Yeah, because the bounds would be not fulfilled, and then there's no such thing as an efficient portfolio over here and over here. Okay. Everyone happy so far with the code example? Yeah, the code snippets are so that you can work with it. I don't post that because I would like you to play around yourself and spend some time to code it yourself, to have some practice. That is the reason. But all of the code you need is on the slides. Good. Then we move on to the second milestone of today, and that will also conclude our MBA investment intuition section of this class. Yeah, so if you feel a bit shaky after tomorrow, then just repeat these slides. That should be something which is in your DNA, so that if you talk to a professional and you can talk according to the information revealed on the slides, you will appear pretty informative, yeah? And then the industry person will like that. Okay, so I called it a fresh look at the CAPM. So maybe who has never heard of the CAPM? Okay, who took the investments course? Okay, thanks. It just helps me a bit too. Okay, great. So it's a fresh look, so best thing in a fresh look is you have never seen it, right? Otherwise, focus on the fresh in fresh look. So right now we will talk about the CAPM. So it's a capital asset pricing model. It's a model for which a Nobel Prize was handed out, financial economics. It builds on Markowitz after he got a Nobel Prize for the portfolio theory. So these are the two big pillars in finance. Yeah? So we have them in the intuition part. We talk about theoretical insights today, also the empirical implementation. The exercises I don't have on the slides, I could post them. Since we don't have an exam on the slides, it's not yet posted, but I can do that. And you see from the theory insights already, the CAPM is a very beautiful tool. Yeah, just to be upfront, there are many criticisms of it, but I like it, many others like it. It's a nice way to think about why in equilibrium something has a higher expected return than something else. And it's very important if you do machine learning type, big data type, explorative analysis on predictability, and we will have a problem set on that, because you find something and it might be, hopefully it's statistically significant, but even if it is, there are all types of problems. We talk about these things. So what practitioners and academics want to have, they want to think about, is that an equilibrium outcome I'm finding here? Or do I find some very realistic thought of why what I found doesn't make any sense? Yeah? So the CAPM is about thinking, does it make sense? So it's about, does it make sense that a firm has a higher average return than another firm? Yeah? Or does it make sense that if I invest into cryptocurrency, that the expected return is different than if I were to invest into Apple? These are very important fundamental questions, and it's difficult to answer these questions. And the CAPM is a theory which provides us with an answer. And if you would make a survey across financial practitioners, how they compute expected returns, then more than 90% would do something related to the CAPM. Yeah, so it's a blockbuster argument and thought. And what comes out of the CAPM will be that we can decompose the return of every asset into two components. One component will be something like a passive return, something which doesn't require skill, something I can just replicate by buying an exchange-traded fund on the market. Yeah? And then there will be another part which in industry and in academia is called alpha. And alpha is like skill. Alpha is, that's the champion. That is what investors are chasing after, because they can buy ETFs themselves and replicate the beta exposure. Having said that, the CAPM is also a nice example of how knowledge moves from academia to industry in finance. So the CAPM was published around in the late 1960s. So it was just known among the academics, and industry didn't like it. Why? Because industry got a big fee for investment advice. And we will see implications of the CAPM is that you decompose the return into alpha and the beta part, and the beta part is easy to replicate yourself. So I don't want to pay a fee for that, right? So, but the industry was getting a fee for that, so they were reluctant to accept the CAPM. But then, like you guys, you went around the 80s, students went to the business schools, they got trained in all of these concepts, and then as customers, they went back to industry and then said, no, I don't pay for that. And then there were other firms who started to say, okay, I don't charge for this beta exposure, I just charge for the alpha. And that's how you change the industry. Who has heard about Vanguard? Yeah, so maybe a half. So Vanguard is a term from now on everyone knows. So it's a firm which provides these ETFs. It was one of the very first firms, most likely the first firm, who took this CAPM idea and said, since the beta exposure can be replicated by an ETF, I provide you with ETFs, exchange-traded funds, on the S&P 500, on the DAX, on long-term bonds, and the like. Yeah, so this, you also see how a new industry got developed because of that theory. So the typical asset managers received less fees, but then the disruption went creating a new industry like Vanguard or BlackRock. BlackRock also is a big provider of ETFs. It's just because nowadays everyone, I claim, is investing according to this CAPM insight that whatever you can do yourself, this is the beta exposure, you do just in a cheap way yourself. buy yourself an ETF on something you want exposure for in order to get the risk premium. And if you want extra skill, you pay a fee for that. So we have to talk about, is there any skill in industry, yes or no, and the like. Okay. If you take the CAPM and you implement that empirically, it will also be called a single factor model, because the return of every instrument will depend on the return of the single factor, which is the market. Think about like the TP portfolio. And that also has revolutionized to a big factor investment industry, where you have firms who offer different types of risk factors, and you can do all types of computations with it. I have one example here for the single factor model. So let's go back. What's the key? The key is now to understand what's the inside of the CAPM and why is it really useful. And one more thing, because financial data science, I also like to use the CAPM if I model the dependence of different instruments. Because I could ask the data to find a pattern, but it's too difficult because the predictability is too low in financial data. So if I use economic frames, it's like regularization in machine learning, right? Because in regularization machine learning, you're also penalizing specific combinations of parameters. And it's something similar if you have a strong belief that the CAPM in a way is the way participants are pricing instruments, because it's capital asset pricing model. So I will highlight that. It's about how to price different instruments. But how does that square with my saying it's about expected returns? Think about the first case we had. How do we price an instrument? I wouldn't start from here. It was the Economist article, and then we had a case on dividend growth model versus earnings yield model. You write down what are your expected cash flows, and then you divide them by the discount rate. Therefore, pricing and discount rate is the same thing. Right? If you change the discount rate, you change the price. You change the price, if dividends are unchanged, it's because the discount rate changed. So therefore the CAPM, it's a pricing model, and the vehicle is the discount rate. So if the expected return goes up, you're dividing by a bigger number, so the price drops. Yeah? So in that sense, the CAPM is a pricing model, but the CAPM is also a model about expected returns, because that's the medium through which it affects prices. Okay. And if you try to predict the return into the future, if you try to write a model or machine learning approach, what's the return tomorrow? You are after finding the expected return. And this is how the CAPM comes in again, because the CAPM has some nice thinking about that the determination of expected returns should not be random. But there should be a relationship. And the relationship, we talk about it. Okay, so we talk about that expected returns, or using a bit of MBA, corporate finance type notation. We could also call it cost of capital. That's kind of the same. That's determined based on CAPM intuition. I will argue. I also argued, when I say I argue, open up a textbook, it's the same argument. Yeah? So it's not that I make an idiosyncratic argument. Then the CAPM is a natural result of Markowitz. That's also pretty nice. And if the CAPM holds, then there is no alpha. So again, something the asset managers don't like. But by now it's already kind of common knowledge that, like AQR, I mentioned the fund in one of the other cases. AQR has an industry paper, maybe already 8 years old. And the title of the paper is, so it's worth reading if you like, it's about there's no alpha, comma, just undetected beta. So you see also how the CAPM comes into the headline of this article, and they also kind of talk about there is no real alpha, just undetected beta. But let's first understand what is alpha, what is beta, and the like. Now let's talk about the assumptions of the CAPM. First, perfect competition. Like in any economics class, it means an investor cannot affect the asset price. Yeah, so if I'm selling Apple, I do not affect the price of Apple. It will not fall because of me selling. That's the assumption. Investors focus on a single period. The jargon is myopic, Myopic means you only look from today to next period. And next period is not really defined. It could be tomorrow, could be next second, could be next year. Yeah? So it's static is another term. So it mimics very much the Markowitz thing. We have expected returns, we make a decision, we have the outcome. We're not asking us, how does the expected return change over time? Keep in mind, this is from 1967, so it's a few years old. Okay, every investor can invest and borrow at a risk-free rate and trade all in investments. There are no taxes, no transaction costs. Now comes key. All investors are mean variance optimizers. So picture every student in the class as being an investor, and every one of these students is mean variance optimizer. So you are minimizing the variance subject to these constraints. Your utility function is you like expected returns, you don't like risk, trade-off characterized by risk aversion. We talked about that in previous courses. Okay, now all investors, every one of you guys, have the same information and the same economic view of the world. It's called homogeneous expectations, homogeneous beliefs. You also see that's an assumption, right? Because you will have different opinions of the market. But you need that to derive an equilibrium here. You need it, all of us view the world the same. So we agree on expected returns and we agree on the covariance matrix. That's all. And so these are the assumptions. If you start off with these assumptions, then there are a few outcomes. So first, again, it's MBA-like. So I start now with the main message before we go into some details. Now, the message can be summarized to these bullet points on the slides. First, all investors are going to hold the same tangency portfolio because you guys are all the same, right? So therefore, you do the same. You have different risk aversion, but the tangency portfolio doesn't depend on risk aversion. And therefore, you will all come up with the same tangency portfolio with the same capital allocation line. Good. Now, since this is the case, and since now we assume all of you are the investors of the market, there's no one missing. It means that the tangency portfolio must be the market portfolio. That's also an equilibrium outcome. Because if you invest 100% into risky assets, you will hold the tangency portfolio. And since we are all the market together, the tangency portfolio must be the market portfolio. Good. Which means from now on, we don't talk about the tangency portfolio anymore. Now it's swapped and called market portfolio. Also in industry, they will usually talk about the market portfolio, not about the tangency. Okay, so the next insight is that the risk premium of the market portfolio is equal to A times sigma square M. So it says that the risk premium of the market equals risk aversion of basically, it's the average risk aversion of all of us, since we make up the market, times the variance of the market return. Now that relationship usually gets overlooked because people focus on the second one, but it is an outcome of the CAPM, and it's very useful for financial data science because it gives you intuition. It gives you intuition of when do you think the market premium goes up. You think that the expected market return goes up if the market gets more risky. Yeah, so it's in times of crisis. The variance is highest. Now, that is a question. Do you think the variance of the market return is highest at the beginning of a crisis, at the center of a crisis, at the height of the crisis, or at the end of a crisis? When is the variance of the market return higher?
At the center of the crisis?
At the height of the crisis. What, all else equal, what does it tell you? It tells you at the height of the crisis, the risk premium is largest. So all else equal, you should invest into the market. It's attractive. And see how difficult it is for also professional investors to scale up their investments in the middle of the crisis, although they are aware of that. One reason is predictability. Is that really the height of the crisis? Then the second thing is they go in with a lot of leverage. So they can't afford too many losing rounds. Right. Another reason why the market premium should be rising is if risk aversion goes up. And again, risk aversion is difficult to grasp in quantitative numbers, but qualitatively, I referred to that last class already. If the borrowing if there's easy money in the market, yeah, usually investors have low risk aversion, yeah? Or if you have deregulation and the like. Yeah? On the other hand, if you have these trade conflicts and the like, risk aversion is usually rising because people get more scared. It's hard to measure, but just intuitively. And what the equation tells you is all else equal, the risk premium goes up. And from valuation, you know, all else equal, prices drop. Yeah, so it gives you a very nice thinking frame of how something like the trade conflict. Like yesterday, I've been reading the headline, China and US are agreeing on a trade agreement. So it's hard for me to predict qualitatively what the impact is. So I go back to these equilibrium insights and I think, okay, risk aversion will drop. Market risk maybe as well, most likely, so all else equal. I would have a drop in the expected returns. So price equals dividend divided by expected return, so I should see prices go up right now on the next trading possibility. So that's how we use the CAPM for thinking. And I think this is realistic. You most likely will not read if they come to an agreement that market prices drop, right? So it's kind of consistent. But it helps you think that if the premium is now dropping, the price rises. This is inverse relationship. Okay. But the second key, and this is what most people know, is that the expected excess return of any asset I depends on the market's risk premium times covariance of the return I with the market over the market's variance. So we will derive that in a moment. This covariance over variance is also called beta. You see, from a regression point of view, it is the slope coefficient is often called beta in a regression. So in finance, if you say beta, or if someone else says beta, they have in mind the covariance of the specific asset return with the market divided by the market variance. Yeah, so it's a fixed term. So therefore, with using this fixed term, we see that there will be a linear relationship between if the market return goes up, also the premium of asset I goes up if the beta is positive. But if the beta is negative, it would go down. That's something a few MBAs usually overlook 2 weeks later, because the beta can be negative. And you see it from here, the covariance can be negative if the correlation is negative. Well, that's a nice insight already for your intuition. If you have an asset I that has a negative correlation with the market, previous case, we call that a diversifier, then the equilibrium return of the diversifier should be, if this one here is negative, the premium of the diversifier should be negative. And it's an equilibrium outcome. So I want to stay a second. Why is this an equilibrium outcome? It's a very nice intuition. Think about the case we had, maybe it was commodities, I forgot. Did that have a negative correlation? Let's assume yes. So we saw if we add commodities into the LTP portfolio, the Sharpe ratio was rising dramatically up from 0.7 to 0.8. So we all want to hold commodity. Now again, we are the market. Now what happens? We are all the same by assumption. So we all want to hold commodities. So there's only a fixed amount of shares or of ETFs outstanding for commodities. Yeah? Or if that's too abstract, think about commodities being a gold mine. You just have, let's say, one gold mine. Which means if we all want to buy it, who's going to get it? The one who offers the highest price. Right? And now go back to case number 1, valuation. The one who offers the highest price, ignoring the cash flows, is the one with the lowest discount rate. So in equilibrium, it should really be the case that the expected return of a diversifier is very low, even negative, because its price is so high. Yeah, so if you think back to my example gold in last class, I said even though gold was falling from 1700 down to 1200, I went back to this thinking. I thought it's a diversifier. The expected return can be negative. If it correlates negatively with the market, which it does, gold, at least at that point in time it did, the expected return should be negative. That's all right. It's a diversifier. Okay, so these are the implications, the messages of the CAPM. Now again, we are in the MBA section, so I have a 5-step proof, which reveals the key essentials. So I want to derive this CAPM relationship, the last one here, this one. So let's do it. Step number 1. The optimal risky portfolio is the tangency portfolio. We talked about that last slide. Therefore, we call it a market portfolio. Okay. Now, the second step. What is the systematic risk? Now, systematic risk is the risk you cannot get rid of if you hold a very well-diversified portfolio. Now, the best diversified portfolio is the market portfolio. Therefore, systematic risk from now on will also be called market risk. And what is market risk? It's the variance of the market's return, sigma square m. If I wanted to, I could write that as the covariance of Rm with Rm, which is fine. Yeah? Because also big sigma is called the covariance matrix. Because on the main diagonal, I have sigma I with sigma I. Okay, good. Now the third step. The optimal total portfolio, or we call it the complete portfolio, is a combination of the T-bill and the market portfolio. Yeah? So we are moving along the capital allocation line. You see how Markowitz really comes in here. Okay. Now step number 4. If we are adding a security, so let's say we are holding the market, or we are somewhere on the allocation line, it doesn't matter, both the same, because the risk is only characterized by market risk along the allocation line. And now let's say Apple issues another stock. Yeah? So they increase the share base, let's say by 1 stock. If you now take that 1 stock into the market portfolio, then although Apple has a volatility of 50%, roughly half of that will diversify. Yeah? Because you have a well-diversified portfolio. So it's not the full risk that will show up in your portfolio. It's only the risk which co-moves with the market. So therefore, if Apple has a correlation of 0 with the market, then risk would not change if I add 1 additional stock of Apple into my portfolio. Yeah, that's something you need to try to grasp. Take commodities, negative correlation asset. If I add commodities, it will even reduce the risk of the market portfolio. That was case number 2, and that's why the Sharpe ratio went up, because we were reducing risk. Right? Therefore, you see that the key quantity of risk for a Markowitz investor is not variance or volatility anymore. It is the covariance of the asset's return with the market. Now, let me share one thought to help you thinking. If that's not clear to you, you might still think about yourself, how you invest. But it's an assumption of CAPM here to assume you are Markowitz. Markowitz will always hold a diversified portfolio along the allocation line. And that's the key thing. Right? So by definition, by assumption, you always have a well-diversified portfolio, and therefore every security that you look at will only add covariance risk. If you're not diversified, it holds, then all of the risk will come to you. But that's why the assumption is important. You are diversified. Okay, so therefore, a Markowitz investor, when he or she looks at the additional Apple stock and asks, what's the price that I should pay for it? Well, now comes again an equilibrium insight that the security prices, so all assets in the market, as well as the newly issued stock, should be priced such that it's not that prices need to be the same, because we know prices are cash flows over discount rate. But it has to be that the risk-adjusted discount rate, so the expected risk premium per unit of risk, that needs to be the same. Now let's imagine this is not the case. Let's imagine we have two assets and their risk premium per unit of risk is different. Then we know from the allocation line we can always lever up and down. We want the highest Sharpe ratio. So we want the highest risk premium per unit of risk. And therefore the equilibrium will happen that people, whatever has a risk premium per unit of risk which is higher than something else, they buy that instrument. But as they buy the instrument, the price goes up because demand and supply. Supply is fixed, demand goes up because we're buying. So if the price rises, cash flows are unchanged by our purchasing. So the price is rising because the expected return is dropping. Therefore, you see the price is going to rise to the point where 0.5 holds. So prices are changing to a point where the priced in expected risk premiums per unit of risk are equalized. And now the combination from above is that if you now compare the risk premium of the Apple stock, let's say with the market, then the variance of the market is the risk measure for the market, because that is all the risk you hold, while for an asset like Apple, IBM, or cryptocurrency, the risk that you hold as a well-diversified investor is only the covariance risk. Yeah, and this is the point that sometimes was difficult for the MBAs to grasp. But you have to come from the assumptions of you are a Markowitz investor. Only diversified portfolios are what you're holding, and therefore it's only the covariance which matters. And if you now rewrite that, you see that in equilibrium, Sharpe did derive that, Sharpe, Lindner, and others, that the expected return of asset I, I'm just solving here, plus RF times covariance, equals risk-free rate plus the beta, which is defined to be covariance over variance, times the market risk premium. The way in research we use that in data science applications is it's like a regularization, right? It regularizes, difficult word, many R's. It regularizes how expected returns are allowed to move relative to the market's expected return. If the model is good, it's a good regularization. If the model is bad, it's a bad regularization. Research I have seen is that imposing a regularization helps. It has to do with these pricing, as I've mentioned, that's the way it works in industry. At least partly. Okay, now instead of the capital allocation line, we will also have another line. It's called the security market line. And that is something we are talking about. But you see it already from here. The security market line will plot the expected return of an investment relative to its systematic risk beta. Yeah. So I call it now beta systematic risk. You have to, it's a bit, we can call covariance to be systematic risk. Beta is also called systematic risk. So to be more precise, beta is like the normalized systematic risk, because we are normalizing by the market's risk. But in industry, people just say beta is systematic risk. Good. So here's a picture also from the Bode Marcus textbook. We see here the security market line. We have beta on the x-axis, expected return on the y. We have a linear relationship. If the beta is 0, the expected return is the risk-free rate. And then the slope is the market premium. Yeah, because it's the change in y over the change in x. So I choose change in x beta 1 versus beta 0. So this is the market beta. And then I have here the market's expected return. This is the risk-free rate. So therefore the spread here is indeed the market premium in expectation. And the CAPM now says that the expected returns which are priced into the valuations line up on that security market line. So if you have an investment, let's say the BMW stock, and it has a beta of 1.2, then its expected return should be risk-free rate of 6% plus 1.2 times the market premium, which is 8. So in total 15.6%. We would call that to be the fair expected return or fair valuation. Now what happens if the same stock trades at an alpha of 1.4? So let's say that BMW beta 1.2 has an expected return of 17. Well, according to the security market line, it means the expected return is too high. If the expected return is too high, what happens to the price of that instrument? Because it's too low. So at first the price is too low. Because the BMW stock should discount future cash flows by 15.6%. But if the expected return is 17%, we are discounting by 17%, by more. So the price is too low. So this is what industry knows. If you have a positive alpha asset, it means it's too cheap. So you want to buy it. You keep buying it, the price rises, because supply is fixed, demand goes up. Maybe you talk about that. So even more demand comes in. So the price is rising, rising, rising. And the price rises until the point where the expected discount rate is 15.6%. Then you are in equilibrium. Then the price properly reflects the riskiness of the instrument. So you've heard the term in industry, buy low, sell high. That's a good slogan, right? You want to buy low, you want to sell high. In terms of alpha, it means you want to buy positive alpha and you want to sell negative alpha instruments. And when I said that in industry, skill is defined as being able to detect alpha, you see, it means being able to detect undervalued instruments. So for example, Warren Buffett is very well known for being able to discover in a traditional way assets which are undervalued. Machine learning nowadays is the more modern approach, which is not, maybe it incorporates fundamental analysis, but it's completely just data-driven. Although Warren Buffett is also data-driven. Just the model he has in mind is different. Good. So here's the CAPM intuition. So the intuition is that an asset has a total return, and it has different components. We have the risk-free component, and then we have the risk premium component. And now the risk premium component has two parts. It has something we call beta return, or it's also called a systematic return, because it has these systematic co-movements with the market. And then we have an alpha component. And that is called an active return, or it's also called abnormal. Yeah, why again abnormal? Because normal means security market line CAPM holds. Good. You can replicate systematic beta risk by simply a constant beta exposure. So let's say I want just to participate on the growth in the world economy. So I can just buy an ETF on an index which is mimicking / replicating a world portfolio. And that's it. If you look at the management fee, it's very cheap usually, 0.2% maybe. So that's really cheap. On the other hand, if I want active exposure, then there are different ways to get that. The thing about Warren Buffett, he is analyzing business models, balance sheets, the economy very actively. If you think about a quant fund might predict the market premium, and if it thinks the market premium goes up, it would increase the beta. If it thinks the market premium is dropping right now, then it would reduce the beta exposure. That's called beta timing. So it tries to time the beta that is considered to be active, so alpha. And if you now think about total risk of your portfolio, so think about the variance of your portfolio, from now on you can decompose that into two components. One component is the beta risk, so that is the co-movement with the market, and the other one is the active risk. It's like, we will later see, that's like the epsilon if we were to run a regression, where we regress the the firm's premium on the market premium. Quick anecdote, there's a quant fund, 1998, takes a Japanese mandate 2 months before the Asian crisis. Asian crisis hit, I forgot how much they lost, but let's say 20%. Yeah, I think 1998, it was Asian-Russian crisis. They had a scheduled investor meeting, so they go to Japan. The investment managers are nervous because they lost 16% within 2 months. Let's assume the market went down by 20 or something, maybe 18. So the story is, and it was told by me from the asset manager, the elevator opens and the customer comes in, greets them, and says, "You did a great job." All right? So losing 16% means you did a great job. So let's assume they had a beta of 1, which you can assume if they have a mandate to invest into, let's say, Japanese equity. So you see what they did, they lost 16%, while the market, Japanese market, lost, let's say, 20%. So their alpha was 4% plus. That's the thinking in the industry. Right? It's different than, like, if I talk to my mother, she would say, but I lost 16%. But if you get training in that, you know you can't change that. If you are in the market, you have market risk, and if you said you want a beta of 1, then this is what you want to have. But what you can do is you can beat the market or not beat. And these guys lost less than the market did lose by similar beta exposure, so the customer was happy. It's an extreme anecdote, but it's true. I don't reveal anymore, but I say it's true. Yeah? So I think it's something you keep in mind. Okay, there's Malkiel, a professor at Princeton. He was professor in 1995. He did run a regression he did regress the return of a fund on a minus the risk-free rate, so that's the realized premium, and he regressed that on the market premium to estimate the beta, the alpha, that's the intercept of the regression, and then he gets an epsilon. He does that for all equity mutual funds which had at least a 10-year continuous record, and he used the period 1971 to 1999. So here's the display of the alphas that he did compute. So each alpha, oh no, but this is a histogram. So let's take this point here. This is 1. So there is 1 minus 4% alpha. So there was one fund with a minus 4% alpha. There was one fund, these are 2. There are 2 funds with a plus 2% alpha. Right? You see most funds have an alpha around 0. Now this is before fees, and at that time a simple mutual fund charged like 2% fee, which now the hedge funds are charging. Yeah? So you see how the fees go down as the sophistication rises of the customer. I've mentioned that. And kind of the average alpha across these firms has been negative. Yeah? So the average alpha is negative, but statistically not different from 0. Okay. So according to the CAPM, there is no alpha. Right? And kind of he confirms that. Alpha is 0. You also see what it means to have a random variable. Some values are positive, some are negative, but statistically speaking, you cannot reject the hypothesis that the true alpha is 0. And this is before fees. After fees, the alpha would be lower by 2%. And then he also finds 23 funds had a significant positive alpha and 26 had a significant negative alpha before fees. And although the study is already 30 years old, something which we observe nowadays can be seen here. It's very difficult to identify ex ante which fund will produce alpha positively, a positive alpha. Because alpha is a bit like a random variable centered around 0. Empirical research shows that it's difficult if you have positive alpha today to generate positive alpha next year. So there's lack of persistence. So therefore, that's one thing. And the other thing is you see that if firms produce alpha for 1, 2 years, 3 years, that industry likes to put their money into these funds. So it's like a winner takes it all approach there, empirically. There's no theory reason for that, but empirically that's what we observe. So it's kind of the hope that if someone has been able to produce alpha in a more consistent way, that they will also do so in the future, and then fund flow is rising dramatically to these firms. Side note, just for you, if you have time, ask GPT, Wikipedia, like, have you heard about LTCM? Most likely not, I would not expect that. LTCM was a fund, long-term capital management, yeah, long-term capital management, long-term, Markowitz. And they were very successful, late 1990s. They were also called the central bank of volatility. And we will also talk about volatility in this course because it's a very interesting asset class. The central bank of volatility. If someone calls you the central bank of something, it means you do something very big. Right? And what basically happened with LTCM, if you wanted to trade anything related to volatility and you needed a counterparty, they were your counterparty basically. And they were very successful. They were very successful. So they generated alpha year after year. They discovered an alpha, which was undetected beta. Now we know if you're selling volatility, so anyone already did sell an option? Okay, so if you sell an option, on average, you make a positive premium. And that's why we have it in the course where we talk about it and different things related to it. So by now it's established that you get a positive risk premium if you're selling volatility. In 1996, this was only known to a few academics who did option pricing and the like, right? So it was an undetected alpha. No, it was an undetected beta, their alpha. So they traded on it. And there's a book called When Genius Failed. Highly recommend the book. I think the author was a New York Times journalist, so it's very well written. Gives you a nice insight into these quant trading again from late 1990s. And in 1998, they failed, of course. There's always coincidence in some point in time. You cannot have a zero variance in your return. And before they had a problem, they had to give money away. They had to give money back to the investors, because everyone wanted to invest with them. Everyone. So picture any type of bank you have in mind. They wanted to be customer. Yeah. But again, my CAPM thinking. If demand is too high, because they move into trading strategies with a lot of capital, demand goes up, prices rise because the risk premium drops. It's exactly what happened there as well. Yeah? They kind of saw alpha disappears because they are their own enemies for the alpha, because they got too big. So they gave money away, they gave it back, they said, we are sorry. Yeah, you get a letter, we are sorry, the 500 million you transferred will come back to you because we can't find proper investment opportunities for them. So people were really mad. And then the Asian crisis hits, and the Russian crisis hit, and volatility spiked up to unprecedented values. So while they did earn a small premium, now the risk kicked in. And the risk is that the realized variance is much larger suddenly than the variance implied in options the day before. So that you don't have to understand yet, but we have classes on that. So it became really expensive for them to hedge, and they couldn't. Yeah. So, and usually you're saying this is just a hedge fund. Who cares? But there was a meeting by the U.S. central bank to rescue that hedge fund, which is unbelievable in a way, right? Because a free capital market system is about let things fail. But they were so big, everyone was invested with them, that they could not risk to let it fail. And then it was bought, I think, by, that you have to double check, I think by B. What's B? Barclays. Okay, why do I say this? It's a nice anecdote to give a bit of practical knowledge around all the concepts you see. My point was about if something has alpha consistent, its money is rushing in. It's the winner takes it all, but there's always coincidence. So it's not risk-free. So what their problem was basically, they didn't have proper risk management. They did not anticipate that their hedging in terms of the variance in the market can jump up so dramatically. So they were too bullish in their investments. Good, so here's the abstract from the Malkiel paper. Let's just read it. Several recent studies suggest that equity mutual fund managers achieve superior returns, and considerable persistence in performance exists as of 1995, but still today asset managers would talk like that. That's why I have it here. This study utilizes a unique data set, including returns from all equity funds existing in a year. The data enables us more precisely, so you see already the data science perspective, it's about precision, enables us more precisely than the other academic papers to examine the performance and the extent of survivorship bias. Now, survivorship bias means industry is really clever. They bring 10 funds out, 5 funds underperform, they take them out the next year. So the survivors remain. Right? And you are biasing now your data set because you're looking at the survivors, but you want to look at the entire distribution of funds. And this is what this paper empirically did better than the others to account for that. So in the aggregates, funds have underperformed benchmark portfolios. So that's this CAPM thinking, negative alpha, both after management expense and even before the management fee. Now he tries to give an explanation for that. Survivorship bias appears to be more important than other studies have estimated. Yeah, so it seems important that you include or that you control for this survivorship bias. Otherwise, you bias your data set, so you bias the outcome. You know. Moreover, while considerable performance persisted in 1970, there was no persistence in the 1980s. It's also interesting for you to keep in mind. Because if you do machine learning and you find something, and it's consistent with theory and the like, so you understand where it comes from, it most likely also exists. But it will disappear at some point in time. And others jump on the bandwagon, prices go up, so the premium goes down. This entire thinking from today. Right? So therefore, it's important to keep in mind that premium you discover is really something dynamic. It's there for some short amount of time, and then it disappears. And now you also understand how demand and supply contributes towards whether it disappears or not. Okay, I have a few links for you to check at home if you like. So even nowadays, there's a lot of talking about Malkiel and these findings. Malkiel opened up then, or contributed to Wealthfront. Not sure you know that. It's like not sure, I don't like the word robo-advisor here too much. There is not much of a robo, but it's like a, let's just call what media would call a robo-investor. They basically do what Markowitz says you should be doing. You figure out what's the risk aversion of the client, you offer them a portfolio, and you show them it's efficient and the like. And you are replicating the tangency portfolio and the like using exchange-traded funds, ETFs, cheap. You don't try to go for alpha because you know there is no alpha. You just try to go for market premia for beta. Yeah, and Wealthfront did that. Scalable Capital did that in Germany. Who has heard about Scalable Capital? Okay, Scalable Capital wasn't that successful with their robo-advisor, so now they are more known for brokerage, most likely. Or from the ones who has like these actively managed portfolios they had. Right, it didn't work out, and we talk about also in the class why it did work out. And Wealthfront in Scalable, when they started doing that, they had a minimum investment amount of 10,000 euros. For example, Wealthfront had 1,000, and then it's down to 100. So it's just the American version of it. Yeah, make it really cheap, really easily to access, and make it possible for an investor, someone completely without any knowledge, to give them a portfolio which is well diversified and which captures some risk premium. Okay. Now, insights for corporate finance and for investments from the CAPM. Maybe I start with corporate finance. With corporate finance here, I mean valuation, our class number one. So the CAPM implies that the risk premium of a firm depends on their beta and nothing else. Yeah? Why or nothing else? You want to try?
Could it be because in the market the alpha is assumed to be zero? Like, I'm just trying.
No, could be, but try to think about, these are insights, meaning implications of the CAPM. CAPM is a theory. So everything that's implied must come from assumptions. There's a one-to-one link. There's nothing random. So what is it in the assumptions that implies that the risk premium of a firm depends only on their beta?
Probably that every investor holds the market portfolio.
Or a linear combination of market and the risk-free rate. Right, every investor is diversified. So it's my Apple example. And therefore, if I bring out a new stock or a new certificate, I call it crypto. It's highly risky. The volatility, let's say, is 100%. It's huge. But according to the CAPM, that's why it's always important, according to the CAPM, all investors are diversified. So if crypto has a zero correlation with the market, then crypto is a zero beta instrument, which should earn the risk-free rate. It should be priced as if the discount rate was just the risk-free rate. And if crypto had a negative correlation with the market, the discount rate should be below the risk-free rate. Yeah, these are radical thoughts if you hear it the first time, so I try to iterate back and forth so that it sticks. It feels nice for you and for the person listening to you if you have this relationship, if you're strong in these relationships. Okay. And therefore, very typical for M&A, if you price companies which are not traded on the exchange, the way the pricing is done usually, they make predictions of cash flows, okay? But in terms of the discount rate, they are looking for comparable firms which are traded. Maybe you've seen that in an internship or somewhere. So you would see there's a new tech firm coming out. I have to price the firm, so I think about the cash flows, the dividends it pays, and then I think about what's the discount rate I should use, and then I would use the CAPM. I would think about, let's say it's in the tech sector, so I would take the average beta within the American tech sector, if it was an American firm, right? And that for M&A is good enough to get a rule of thumb where the price should be. Now for investment management, the implication is that the investment manager or the customer who interacts with the manager, they need an index which should be the proxy for the market. Like in my anecdote with the Japanese, they clearly defined the Nikkei index is our universe. So you are benchmarked against the Nikkei. So betas, alphas are computed against the Nikkei. This is written in the certificate, in the mandate of an investment contract. And what you then do, you have the index. So let's say here S&P 500. And now I try to make good forecasts of what is the premium of the S&P 500 going forward. Right? So I could use machine learning for that. I take a time series of the S&P 500, try modern machine learning tools. It's like time series methods, try to predict. I also need to compute the beta. So the beta is usually easier to compute. It's simply covariance over variance. So I can use intraday data. We will have a problem set on that. If I have intraday data, I can compute intraday variations, get precise variance estimates, so it's no problem. Same for covariance, basically. Or I could use option contracts. We also have a problem set on that. So getting the beta is not a problem here. Getting the expected return of the market will be the problem. And then the third part in security analysis is about trying to identify alpha. So there I like to think about Warren Buffett, right? He likes to think about different investment prospects he looks at. Does he think the firm is currently undervalued? In our language, does he think the firm has alpha? And if it has alpha, then he thinks I'm now buying, so over time the market will realize that it's a positive alpha firm. Demand goes up for the firm, so its price drops. Price goes up. So Warren Buffett is then selling, right? And he earned the alpha if he's selling at a point where the price is so high that the premium equals the security market line implied premium. So here in this sense, you see how corporate finance and investments, how they come together around the idea of the CAPM. Good. Now let's play around a bit, Markowitz versus CAPM, to sharpen our intuition here. Now we talked about the allocation line, and from now on we could say it's the return risk combination of efficient portfolios, right? Because it's the tangent line on the efficient frontier. So everything is efficient on the allocation line. And the best capital allocation line offers the highest Sharpe ratio. Good. Now, in an equilibrium sense, if you have investors with different beliefs about the investment opportunities, then also investors will have different tangency portfolios, different allocation lines. Just to mention that. So in the simple case at which the CAPM starts, that every investor has homogeneous beliefs, all of us have the same allocation line. So we talked about that. Same tangency portfolio. And therefore the returns which are displayed, think about that, these are portfolio returns, yeah, of efficient portfolios. What we've done this morning and last week. So they move along the allocation line. So if you have a hospital with a higher risk aversion, they will all move along the allocation line, but more to the left. A hedge fund, more to the right. So the risk here is the volatility of the investment, and the slope is the Sharpe ratio. Now, the difference to the security market line is that the security market line, it reads like this. So you have the expected return of every asset I. That's the first big difference. Capital allocation line is for portfolios, diversified portfolios. This one is capital asset pricing model. It's for every asset for which we want to find a price. And that, in its expected return, by assuming investors are Markowitz investors, is only driven by the beta, by covariance over variance. So the market risk premium, market return, is the risk factor, which you can't diversify, that's why you get a premium. And how much of the risk you have is captured by beta. So here I'm writing covariance over variance, and the covariance is sigma I, sigma m, times rho, divided by sigma m squared, so I delete one of the sigma m's. So you see I can also rewrite the security market line like this. So I have the Sharpe ratio of the market as being the slope. And then you see that the risk that, let's say, cryptocurrency, the risk I consider if crypto has 100% vol, I don't consider 100% vol for the premium. I consider it's 100% vol times the correlation with the market. So if the correlation is 0, then crypto has no systematic risk for me. I just buy it at the risk-free rate. So you see easily for data science applications, if you run predictions and you find something has a negative premium, then you should ask yourself, is that negatively correlated with the market? Is there a reason of why this is a hedge instrument? If not, then it's not an equilibrium what you found. Right? Then you found maybe it's mispricing, maybe it's a distortion, but it's not an equilibrium. And if something is not equilibrium, it means it will disappear once others get used to that and start trading on it. So here's a chart. Sorry, I took it from a CFA exam. So I like the chart, so I want to talk about it. It's a good summary in one slide of what we have been doing in the intuition part. Okay. So here we are in the Markowitz world, here we are in the CAPM world. Now we want to aggregate them together. So we know about this one here, we've been doing that. There's portfolio, there's security K, security Q, could be a portfolio, ETF, single stock, it doesn't matter. We have just, let's say, 2 assets here, maybe other assets are all the dots. First thing a Markowitz person does, minimum variance frontier. Then look at the efficient part. Once the risk-free rate is known, find the tangency portfolio. The straight line is the allocation line, so all portfolios will line up on this allocation line relative to risk aversion. Right? That's what we talked about. And now think about this here. We have now the security market line. So we have expected return on the y-axis as well, but we have now the beta on the right. And what do we know? We know that the risk-free rate is here, and it's also here. So the risk-free rate has a beta of 0. Why is that the case? Who wants to try? Why is the beta 0 of the risk-free rate? That's the key, yeah? The vol is 0, so you have a constant, co-move with the market, correlation is always 0. Right, yeah? Good. Then we have here the market. So the tangency portfolio, we said, if we move from left to right, it's because we assume everyone is a Markowitz investor, homogeneous beliefs. Therefore, the TP portfolio becomes the market portfolio. Therefore, already here they call it M and not TP anymore. Yeah? So you see the market expected return here is here. It has a beta of 1. Why is the beta 1 of the market?
It's the covariance of itself divided by the variance.
Right. Yeah. So I really like doing it equation by equation, because later you have many equations, so it's always good to have the equation in mind to be sure it's correct what you say. Exactly right. Just by definition, the beta of the market is the co-movement with itself divided by the variance of itself, so it's just 1. Okay. Now, an interesting question is, look at these two things. You have security K is here, and you have security Q is here. So K definitely has more risk. But they both have the same expected return in equilibrium. That's what we take out of the picture. Why is that the case? Well, first, it must hold that they both have the same beta. Because the expected return, in parentheses, which is used to price future cash flows, is determined according to the CAPM, which means the expected return depends on the beta. So if something has the same expected return, and it obviously has because it's on the horizontal line here, it must have the same beta. So how can Q and K have the same beta if the volatility is different?
Because we have different covariance.
Right, covariance is different. If you decompose the covariance, it's sigma K times sigma M times the correlation. And for Q, it's sigma Q times sigma M times the correlation. So the product can be the same, although the sigma K versus sigma Q is different. It's because the correlation of K is lower. This is my extreme example with 100% crypto vol with a 0 correlation. No systematic risk. Right? So here it's just the case that more of K risk can be diversified relative to Q risk. And a diversified investor cares only for how much of an individual's asset risk is systematic, because the rest diversifies away once it gets included onto the allocation line here. And everyone is Markowitz, that's the big thing. Good, now there are different risk measures, just if you come across. Now there is a Sharpe ratio, M² measure, which I haven't seen much. There is a Traynor ratio, which I see sometimes. You see it in financial, like Yahoo Finance or the like. They are reporting usually all of these 4. M² is maybe the least one. And then Jensen's alpha is also mentioned very often. So let's think about which risk measure to use, because there's some learning going on about diversified versus non-diversified investors. Now let's start with here. If you are a diversified investor, so you do what Markowitz says you should do, then you don't have any exposure to unsystematic risk. And therefore, if you compute how much return did you earn relative to the risk-free rate, you would take this relative to the beta that you took. Yeah, like this Japanese anecdote. They care about how much beta did they have and how did they perform. And when they said, when they say you did a great job, they refer to this alpha here. Because alpha for a diversified investor is the excess return the fund earns minus what they should have earned according to CAPM. So you multiply the market's return, excess return, times the beta. And in the anecdote, they had minus 14% here, but this one went down by minus 20. So they had a plus 4% alpha. Now, if the investor is undiversified, then now, practically speaking, that might not be the right metric for them. We could say it's your fault, you should be diversified, but we can't say, right? In the theory, we can say, we assume everyone is diversified, but in reality, think about venture capital. Venture capital on purpose is not diversified. Maybe they have the 1/n rule, they have like 5 bets per topic, but on purpose, they don't try to hold the market because they would just hold beta. So for private equity, proper risk metrics might be to consider the total risk of the investment. And also here, this is like the alpha, you take the excess return of the portfolio per unit of risk of the portfolio, and then you scale it up towards market volatility. So then you can compare, if you were to use the same vol in the market, would I beat or not beat? Okay, as I said, Sharpe ratio and Jensen's alpha are usually the most heavily one used. Okay, now if we implement the CAPM empirically, we've seen what Malkiel was doing. You take, let's say, firm I, you collect different time periods, and then minus risk-free rate, and then you regress that on the market excess return. Now, statistically, the beta is exactly covariance over variance, so the CAPM beta is also the OLS beta. You compute the alpha, you can check are coefficients statistically significant, yes or no, and then here epsilon is your unsystematic return movements, yeah, and this would be your beta movements. And what has been done in industry and also in academia is to start with this CAPM thought and to say, okay, the thinking seems fine. Maybe systematic risk is not properly captured by only one factor. And then they start to add different factors. It started PhD dissertations, University of Chicago, and these are the professors related to that. They made papers then out of it, that they found there are other factors which provide significant estimates of future returns. Yeah, it's the value factor, its size. So small firms tend to perform better than big firms, or a value firm tends to perform better on average than a growth firm. Now, a value firm is a firm with high dividend yields. We saw it case number 1, how we are rotating back. Yeah? Dividend yield is predictive, was known. Pharma French, they run a cross-sectional analysis. They compute the dividend yield differently, but it captures similar information. So kind of about value, think about dividend yield high, size is market cap, and then the third factor was the market factor, and that got extended. It was momentum. Yeah, it seems a firm which performed well over the last 10 months, they tend to perform also better next month. It's momentum. It was published 1997. Then the pattern got weaker as it got published. We talked about it, yeah, it vanishes because if it's not equilibrium, people trade on it, and this affects prices, then the pattern disappears. But momentum still appears, but it's weaker. Then there's short-term reversal. A firm which underperformed last month tend to perform better than the overperform of last month. And it continues like that. It's called a factor zoo. There are more than 200 of these potential factors. There's a big industry out there who is selling these factor exposures, and different firms use different factors to characterize systematic risk. So in that point now, it becomes an art. The science is to understand how from Markowitz we come to the CAPM, and then the art is how it's implemented in industry. And everyone does it differently in terms of which risk factors do they use. If you think about machine learning, what they would do is they would try to predict, and whatever predicts is their factor. And if you think, this is outside of the course for now, but if you want to think about like a neural network, if a neural network predicts, it also just represents your prediction based on some layers and neurons. So it's not a linear CAPM mapping, although inside an activation function it's also linear. And I've seen approaches in finance who are working with a linear, with a CAPM inside such activation functions. So the point I'm saying is it's really worth understanding well Markowitz and the CAPM, and then you have all you need in order to tackle sophisticated financial problems. One example, so 5 more minutes to go, it's the second last slide. The CAPM also brought to the picture you remember the picture with the 2 columns. Risk has systematic risk and the alpha risk, so it's related to this one here, that from now on you should think about total risk is the variance of a return. It has 2 components. One is systematic, so it co-moves with the market portfolio, tangency portfolio. That is systematic risk. And the other one is firm-specific. Like the diesel scandal Volkswagen, it's a typical diesel idiosyncratic risk component. And you compute systematic risk by getting the beta, so you would have to run a regression to compute that, or you use sample means, but it's the same than regression. And the regression is kind of the one-factor model, so we talked about previous slide. It also represents that security market line, because the return should depend only on the market's return in a linear way. And then you see kind of, if you take the variance operator to the left, this is sigma I square, total risk. And now you take the equals, the variance operator to the right. Alpha is supposed to be a constant, so it has no variance. And then you have the variance of the sum. Epsilon is idiosyncratic, which means orthogonal to systematic, right? Uncorrelated. So therefore, the variance of the sum is the sum of the variances. So the beta is a constant, so the variance of this part here is beta squared times the variance of this. And this is the variance of epsilon. So you therefore see that you can decompose the variance of any instrument I into systematic risk and into risk that will disappear once you put asset I into a well-diversified portfolio. If you want to read on that something outside of class, you can read about Barra, B-A-R-R-A. That's a risk analytics firm who is providing to industry such risk decompositions. Okay. So to summarize, CAPM is the most popular theory on how the discount rate of a project, of a firm, of an asset depends on systematic risk. So according to the CAPM, we have that cost of capital of a firm is simply risk-free rate plus its beta times the market premium. So therefore, it can happen you have a high volatility stock, but that stock pays low returns on average. And it has to be the case if the beta is low. So most of the risk gets diversified, if you hold that. Okay, otherwise, or the same, only systematic risk gets compensated because we are Markowitz investors. Unsystematic risk gets diversified. So the Markowitz investor doesn't care about firm-specific risk. It will just vanish. Okay, and then I mentioned more recent models. We didn't have just many factors. So we have the multivariate modeling, basically, based on this CAPM thinking. Okay, that is going to conclude our intuition part. And thank you very much.